I'm going to turn over to our guests of honor.
Yes, okay. Thank you. I don't know where to start on this, especially with the time. I guess the best way to say it is we were trying to figure out which order for us to go, and it was pretty clear. I think at least some of the people in the room here remember Johnny Carson's show, right? Well, if you remember the whole show, Ed McMahon would come out and warm up the crowd before he came out. So you could think of me as Myron's Ed McMahon. Okay, so I'm doing the first up. Anyway, first thing I want to say is I can't tell you the words of what it means to see so many of you, some who I've seen often, but still in this context. And it's great so many of us are here. I mean, the first thing about the 40th anniversary I like is we're having it. So, you know, but if I can't say anything else, I don't have any words to say it except, it's like a history book, you know. I just don't even know what to say, so I won't. Now, someone mentioned something about, the good and the bad or something. You may have noticed, Myron, I'll say at least we were taking notes through all the discussion. We were going to comment on it. Actually, I was doing two things. I was taking notes on what the various speakers saying and busily crossing out things I was going to talk about that all got done. And it was a race to see if there was anything else that I could say. So, and then a few other things before I move to my remarks. One is, Bill, you mentioned Leo Pomerantz as the first, I guess he was first chairman of the exchange. Well, just to close the loop, Myron and I, we were talking about how before the stuff was published, it got into the, Myron and I went to Wall Street, what was it, late 71, 72? So, to DLJ, because, they were the only one crazy enough to talk to these guys. Because at that time, for those of you who are in a different era, Wall Street had only one thing to do with quants. They kept them in a room far away from clients. And they said, here are our Picassos, open the door. There are quants, close the door, and they're gone. And so that was the negative of it. The positive was wasn't much competition. There weren't many quants around. So anyway, we took it to Wall Street and did a lot of this stuff early on. And so anyway, I just wanted to close the loop that Leo and all this, it's the same family. Let's see, what else I had. You mentioned the Fisher Black service. It was really amazing. He had this process of which he was producing, this service all the time. And, it's hard, as mentioned, but this computational difference between having sheets, I thought we were doing very well when we took the Black-Scholes formula and doing dimensional analysis, took five parameters variables and reframed it in dimensional analysis, so you only had 2 dimensions to do, so you didn't have that much paper to have. And you heard the mention about the TI calculator, which I got the much better story about, more detailed story about it, but the TI calculator, this is a Myron story, so I'm taking some of his time for it. And they had this hand calculator, which eventually was first done privately, but then other people do. It was sort of programmed up, and they could get the hedge ratios and everything. And Myron found out about it, and first, for us, because Myron, I'm shy and he's not, and he called up. He called up TI and said, do you think any royalties are available here? And he said, of course not. It's in the public domain, which we knew. Then he said, can we get a free calculator? And they said, no. Anyway, but I don't want to speak ill of TI. After all, the Green's building here, Cecil and I, the Green, we're very generous to MIT, so we'll give up the calculator. Another feature that came out today, and you saw it exemplified in the presentations, is the difference between the manifest and latent functions of markets. The manifest function for a market is to trade, right, to exchange. But a very important latent function is information. So even if you have no interest in trading, we know we watch markets for the information. And what you saw very richly throughout here, that theme. And in some sense, it may be I don't know how you weight them, but let us just say you're seeing more and more the informational role of markets and how they can be used. And I remember when Dave Mullins went to the Fed as vice chairman, he was a student of ours. Most of you know David, but can you imagine saying we have a student who retired as a vice chairman of the Fed in 1993? Anyway, his gift, he had to bring a gift to the Fed, and what he brought was looking at the Treasury bond, volatility, implied volatilities on the Treasury bond. So those are a little few things I just wanted to mention. The sort of idea that you can look at history to predict prices. That's the normal method, right? You look at historical data, and then you estimate what you think the prices of the model, the parameters. But that's backward looking. And my story, some of you remember for that, is like, those who know me, I'm a conservative driver, but sometimes I drive a little fast. So I'm driving down the Massachusetts Turnpike, but looking in the rearview mirror to see if I had any intervention behind me. And I suddenly realized I was driving 100 feet a second looking in the rearview mirror. Now, that works really well if what is in front of you is the same as what you just left. But of course, if the road changes, you driving in the rearview mirror is not a good one. And that's my metaphor for the importance of all you heard about these supply things, where you look to market prices, what the market is saying now, and use that as information, because that's forward-looking data. And you saw some of the charts like the Kuwait, the first, had a number of Desert Storm thing. Everybody in the world knew that there was a deadline. But if you just lose the historical data, you would have gotten crucified. So that theme, I think, came very much out of what we've done over the years, and I wanted to underscore it. Now, one other thing I want to point out, particularly in the last panel, but all of them, there were some very senior people up here, right? I mean, leaders, not only leaders because they were, but they're very senior people. And you saw what this last session, you saw those slides, right? Ben and Doug and Bill, of course, sorry, put up. Now, what I think you want to take from that is, that's the way it's supposed to be in finance. The most senior people, they may not do the work, they may not know the best way to solve partial differential equations today, but they understand what they're doing. They could actually give that presentation. That's what we want to have running financial firms. That's what we want to have in the regulatory authorities that are overseeing the financial firms at the most senior level. So they don't have to be PhDs in mathematics. They don't have to be computer science whizzes. They have to understand it deeply. And so when you hear this popular stuff, I don't care where it comes from. Now, most of you know this, but there are people in the audience who are here for other crazy reasons, and more of them the next session. When you hear this common sense stuff, says, what we need is just to bring some sensible people in with common sense to run the financial system. Sort of Jimmy Stewart's type, it's a beautiful life, wonderful life. Not only is that not practical, you wouldn't want that. In fact, part of the reason, and I'm not going to talk about the crisis too much, I think we had a problem with the crisis, is there were too many people who didn't understand that at the senior level and among the regulators. I'm not blaming them only, I'm not saying that's the cause, but it would help an awful lot if there were people who understood it that way. So that was, again, another self-exemplification that the presentations say far better than I could. Now, in turning to a few more remarks, I'm watching. Don't worry, Myron, you'll get at least your time. Okay. So I wanted to go back very quickly and, in this late time, almost not a list, but little touch points, sort of bring us through here. And so I was thinking about going back to the 1970s, and first the academic part of it. Now you have to always correct that at that time we were a bit younger and maybe different, so maybe you see the world differently. But this was a very exciting time. I mean, once this stuff broke, and it wasn't just the options stuff, but that kind of coalesced. It was the whole set of things, the work that was going on. It was a very exciting place, because when we saw this, when you solved this problem, and it was alluded to, you could see it wasn't just about options. It was almost an instant generalization to have come up with a unified theory for the corporate liabilities rather than a chapter on preferred stock, a chapter on this, etc. And I think some of you out in the audience were students. This was a dream. You probably didn't know any better. I didn't know any better. I just started at MIT, so I thought this is what normal life was like. I've since learned it doesn't work that way. But it was very exciting. There was more stuff to do than you could write down. There were more research to be written, new stuff and everything. And the students were in the same boat. They had all these gems lying around. And it was a really very exciting time. And we did, things really went quite well. And I could talk about that for a long time. But what I want to talk about at the same time, because finance got in practice, and I mentioned about Myron, the 1970s for the rest of the world We're not good. I mean, those of you who say, 208, 209 up to now hasn't been so great. I just want to remind you, this is time, that if you weren't there, but even if you look it up, there were a few things that happened in the 70s that, first of all, as I think I mentioned, Bretton Woods that said how all the currencies in the world were going to do since, 1944? That came apart. So suddenly all the currencies became risky. That's not good. Then we had the first, we didn't know to number it, oil crisis, right? Oil went from $2.50 a barrel to about 13 or 14 or something like that. All right? And we never experienced any of this before. You understand? That's the scary part of things. If you've had it happen, like this shutdown of the government, we did it 20 years ago. So it's not good, but you don't see panic yet. But here, you hadn't seen it before. It's pretty scary. So that's Bretton Woods, oil, okay. What else? Double-digit interest rates in the United States. Hadn't been seen. Double-digit inflation. The retirees here at MIT, the professors here 30 years, they saw their fixed retirement things depreciating, 100, 90, 81, 72, pretty soon it's gone. All right? So you had that. What else did you have? High unemployment. In some sense, it's a replay of what we have now, but like the wide tie, narrow tie, wide tie, it's not an exact replay. What's different this time? It isn't inflation. What is it? It's the debt. It's, this enormous amount of deficits and debt accumulation that people are worried about, which is to deal with that is in conflict with dealing with high unemployment and a weak economy. So each time it's a little different, but we had that too. The stock market between 73 and middle of 73 and the end of 74 fell by 50% in real terms. Okay, now I can't remember if there's some others. Oh yeah, we had price controls, of course. One thing, remember, you keep hearing, I'm sorry, this is my opportunity, how everybody says, certain people in particular, like former chairmen of the Fed, who said, we ought to go back to the good old days, the GODs, okay? When everything was good. Well, for those of you who don't know about that, we had a little thing called Regulation Q in 1970, which said that banks could not pay more than 4% interest on their accounts. Guess what happened when U.S. government are in double digits? It isn't exactly a big financial wizardry that you might want to hold treasuries, and that might cause some problem for the banks who were the only source of lending for housing, among other things, and S&Ls, and it was local. So, those regulations weren't great. So if people tell you that, it's a good story, it isn't true. I mean, it was really bad. Now, this is not whacking regulation. It's just saying this nostalgia to go back, you really don't want to go back there, okay? So that's the bad news. But the good news was what? There was a reaction to this. Feedback. All of these risks at every dimension, currencies, commodities, stocks, interest rates, okay? All of these things exploding created an enormous need for finding ways to manage risk. And it created an enormous stimulus for creating the markets that we've been talking about today. It isn't an accident. In the early 70s, we had, I guess, the currencies, when Bretton Woods came apart, we got the futures and currencies. Then we had the CBOE, and we had a series of things. Eventually, we had stock futures and so forth. But the same thing was, this was the incentive. You needed to do it. If you're going to do an innovation, they say in real estate, what's the three most important things in value? Location, location, location. In innovation, I believe it's need, need, and need. We surely had need, and we saw the response of that. And that's what happened. And then, we got ERISA, the entire modern pension system, but it was better. No, it was better than it was back in the good old days when there was no security. The promise of the corporation 30 years later, and if they didn't pay, tough luck, you don't get a pension. So as bad as what we have, that was worse. ERISA was created. The money market, whole money market issue was created because of Regulation Q. The first money market fund wasn't created for its purpose. It was created as a cash management for Treasury for small firms who couldn't have a Treasury department, until everybody, for the reasons I just gave you, were walking upstairs to put it. There were no interest on checking accounts, et cetera, et cetera. So just moving a little ahead with some of the other innovations, it was mentioned earlier, if equities and so forth, and with the 70s, in the 80s it was fixed income. And we created a national mortgage market, maybe something to do with the fact that you couldn't get mortgage money. And as a consequence of that, despite the problems we have, there's always been mortgage money, you may not like the price, available. Much different than when it was shut down. And I remind you, those are big innovations. What else happened? We had interest rate swaps, interest rate futures. I'm not going to get into the debate which came first, the chicken or the egg. But why do I mention swaps? I go back to that former head of the Fed, who made a remark at one point that said, there hasn't been a financial innovation worth anything done since the ATM, which of course wasn't a financial innovation. It was processing information, okay? So I was thinking about that. Think of a Jimmy Stewart bank. Depositors and borrowers. Depositors want to get their money at par, so they have floating, and borrowers like to lock in their costs, particularly in a period like the 70s when you had double-digit interest rates and inflation, you're trying to do a construction product, you really didn't want to speculate on interest rates, nor did mortgage buyers, okay? So those are natural habitats. What does that create? Well, you all know, massive interest rate risk for the banks from the mismatch, where interest rate risk is not relevant or needed to be a good banker. In fact, we all know if you have ability to forecast interest rates like Doug or somebody, you don't do that in your loan book. You just set up an asset management business and you make money and people pay you for doing interest rate. Banking is a service business. And yet they had these massive risks that dominated almost everything else. The only reason you didn't notice it as much because they had perpetual forbearance. They would let banks and others that were totally insolvent continue in the hope that interest rates would come back down. I'm just reminding you down living today. So here we have a former head of the Fed. I hate to pick on him, but he's made himself a pretty big, he's tall if you know, target, declaring no innovation that's been worthy. Did he know about the interest rate swap and what that did for the transformation of banks? Today, you don't know which way a bank is exposed to interest rates. That's huge by itself. Well, I won't go down the whole list of innovations and the financial engineering to implement it, but I think on this occasion, 40 years, I wanted to just say it in front of a camera that, this is the world, and let's look at the facts of what it is. That doesn't say the crisis didn't have its problems. It doesn't say there weren't managements that were incompetent, regulators who were incompetent, people who had bad incentives, et cetera, et cetera. But we mustn't lose sight of the fact of the enormous impact that innovation and risk transfers had for the development of countries and economies. And we shouldn't lose sight of that with all the technical stuff we do and everything else. And that's what's kind of fun. Now, with that, I think I should probably turn it over to Myron. Well, not quite. Myron. I have one more few things. I did want to say on the issue of innovation engineering that the concept, I'll tell you, I started teaching what we call Black Scholes. By the way, I named the model the Black Scholes model. So I have that moment, 15 seconds of fame. Carlos Baldwin, Carlos, you here? Ah, there she is. I'm not going to mention anyone else's names except maybe the former Fed chairman, but she will be mentioned because she was an undergraduate. Her boyfriend, then now longtime husband, said, why don't you go over and take this course? So you came and took it as an undergraduate. Pardon?
He took it and then I took it the next year.
Yeah, he told you to do it. That's what I'm saying. So she took it, and she did very well, and she wrote an undergraduate thesis, and I believe that's the first thesis or other that actually used the Black-Scholes methodology that I'm aware of, on preferred stock. And then we figured she had well enough trained, it was safe to let her go over to Harvard to get a PhD because she couldn't be, she would know all she had to know. And ironically, she didn't write her PhD thesis on that, which would have been really easy. She picked something like irreversible investment, but that's a story for another day. But I did want to point out that, this was what, 1972? And Judy mentioned it too. One of the things we did on the education academic side is we put this material into the mainstream master's class at least 2 years before, well, from whenever I started teaching, I guess I joined in 1970. Whenever I first taught 422, so it was probably the spring of 71, but whenever I first did it, we put this stuff in, along with a bunch of other things, for the master's students. And the philosophy was, PhDs, if they didn't get it, would get it eventually because that's what they do, they read research. But at that time, there was no notion of a continuing education. So if, as you point out with your example, if you graduated with the wrong vintage, it's like Napa wasn't a good year, it was there. And so you're just out of luck. And I think there are a number of people here that appreciate it. Now, I don't want to say, I'll just end on that part. I'll say I think it's always better to be lucky than smart. And again, we were lucky. We put it into the courses, and it turned out to be a good thing to do. And I will leave it at there. I'm not saying it was great foresight. But all of this has come through to today. And then finally looking forward, because I think the big area, some of them touched on today, but the whole area of applying all you know in finance, everyday finance, you know it so well, you think everybody knows it, in the macro financial area, financial risk propagation, systemic risk. It's truly a case of intellectual arbitrage, and I put that in quotation. Some people would say theft. But in either case, you can, to bring that to bear, that's first order. The effects of recognizing the nonlinearities that you all heard talked about, realizing that if volatility changes, even if asset value doesn't change, the guarantees that the government are exposed to, the guarantees of the guarantees, because the government guarantees banks, banks guarantee borrowers, right? So they're guaranteeing the guarantee, all that stuff. That's in none of the macro models that are being used by the New York Fed or anyone else. Those models may have nonlinear terms, but they don't have that structure. They're all basically certainty models with error terms. So that's a big area, I think, for work. Another one is, you all talked about the replication process. I taught that as a production process rather than a price. I said, this is a way, if you were a company, and this is how it's done, you go out, if you wanted to create a squiggle. Anybody here know what a squiggle is? Yeah, you know that contract. Okay, well, don't tell anybody else. I was assuming nobody knew what a squiggle was. Actually, when we do it in class, we don't know when we start the class. The class designs it by committee. And then by the end of class, we figure out what's the production cost for that squiggle and what's its risk. And we use the replicating principle to do it, to show how fast, by understanding the methodology, you could take something that never existed until this moment and get a handle on what it costs to produce as well as what its risk is, which is pretty important, all right? And the production cost depends whether you're a low or high-cost producer. So the final point is there's actually two theorems. This is the production cost. If you're a high-cost producer, it's high. If you're a low-cost producer, it's low. And then the next theorem is the market structure one. If it's a competitive market where price equals marginal cost, then the Black-Scholes price is the market price. If it's a market that's imperfect, that Bob Jarrell was alluding to, then the price could be whatever it is. But you can absolutely separate it and there have more generalization and have different market structures and still have a production process to understand it. It's a production process that can be run backwards, though, unlike real-world ones. And that has its implications. And finally, that also solves what was called the Hackinson catch-22 paradox. After the option model got all this accolades, Niels Hackinson wrote a little story. He said, well, this is kind of strange. He said, because of the replication principle, all options are redundant securities. We can get everything we want from them just from using the regular markets and trading, in which case they're irrelevant. And if the replication principle doesn't hold, then the model is wrong. So that seemed like a lose-lose situation. But if you look at it from a production point of view, if you think of what's a relevant production for the pricing of almost anything, it's the lower cost producers. Then maybe the lowest cost producer get out, but if everybody else like me is a high cost producer, there's consumer surplus, and having the options do matter. So, all of this stuff fits together. And I just wanted to say to you that I think the opportunities going forward, as you heard, are exciting. I came back to MIT at a time where many people would have been leaving. And I couldn't leave this. This is too exciting. And on the issue of teaching, you've heard about things, most of you know about our MFin program. What really brought me back on that domain, was the idea that we're training people really, really well in finance, young people, to be staff. They have no experience. They'll get the experience, but they have no experience. So that they can go to central banks around the world, so they can go to Wall Street, they can go to the IMF, okay? Well, they'll have staffs that really know how to execute what you and decision makers want to get done. If you don't have the Indians, the troops who know what they're doing, you can give all the orders you want, and you'll not get it done. So I think MIT is fulfilling what it's done for the last 40 years in this domain, in both the research and financial engineering and being at the head, but also on the teaching side. And I just want to thank you all, and this is great.
The paper.
It's all right.
What time do we have to before we have to?
You need as long as you want.
Okay, there you go.
I checked that before.
Oh, okay, good. Well, thank you. It's always Bob always used to let me go first because he always does things much more elegantly and beautifully than I can, and more enthusiastically, given he's younger than I am. And I guess in some sense, reflecting back at MIT, one of the joys that I had when I was here in 1968, I came, and then obviously Stu was here, and he stayed and stayed and stayed. So Stu's been here the longest, I guess, of our group that initially was with us all, including Franco and Paul Samuelson and others that we were here. But it was a great time for me, and one of the unexpected joys was to meet Fisher Black in a lunchtime, and then when I had the desire or the interest in telling Wells Fargo Bank that they should invent a passive product and not try to have active management, which was the precursor, I guess, of index funds. Then it was the case that they said, do it and do the research for it. And I said, well, I'm stuck here with Stu teaching, but I have this friend who I met who was thinking of leaving Arthur E. Little, and I said that we could work together on that. I'll talk to him about it and see if we can implement that. Well, that was a terrific collaboration for me, and because I was not only able to, with Fisher, obviously, to work on the option pricing technology, but a lot of other papers in the investment side as well as the option side. And it was obviously, we wish he were here with us, and wish he were also alive at the time that we had the Nobel Prize was awarded. But obviously we all know that he was, even though he wasn't physically present. So it was terrific collaboration. And then obviously when Bob joined us in 1970, right? Then it was the case that it sort of made this place alive and full of energy. And so it was a very creative time. And as Bob said earlier, someone said earlier that there was so many low-hanging fruit around on the trees that we could pick them up and do research as we wished. And so we thought all of finance, or all of economics, the way we define finance, as being uncertainty, and thinking about uncertainty as the primary thing, as well as what Stu said, valuation, but thinking about uncertainty and how to address it. It was a wonderful time to be here because there were so many problems that hadn't been addressed, so many things that were done, and the idea of being able to talk about them and fully discuss them, other than Fisher and I were a little bit worried about Bob, Merton, and Samuelson. So we husbanded our meat, that we had discovered, making sure that our meat we got as much meat as we could before we exposed our meat to Bob. And as soon as we exposed our meat to Bob, we were dead. He was immediately on it, and it was great to have that differential. One thing I'd like to say is that Now, at this juncture, it reminds me back of the time at my MIT office when an older gentleman came into my office, and I was describing for him, the Black Jensen Scholes paper where we had found that the zero beta portfolio had outperformed, or it was high reward, and you could lever the zero beta portfolio and get a terrific return. And this gentleman who was older said, "Son," he said, and I said, "Look, if I was only been born in 1926, and I could have used this technology, and look at how much money I would have with this zero beta concept." So he said, "Son," he said, "would you rather be rich or old?" So it's kind of an interesting question, in terms of richness in your experience that you had and the interactions and the great fun you've had over these years in the profession, and then saying, would you now rip it all up, at this current juncture and start over again? And I don't know. I don't know the answer to that question. I think at this moment in my life, when I'm as old as I am, that basically ripping it up and starting over again would be really terrific, because you basically have a chance to create and to learn. And whatever we have done, or I have done, it's always been learning or trying to learn more and continue to learn. And as long as I enjoy learning, that's terrific. And I think that keeps you young. But to learn, you also have to, as Ben said, and what he said earlier, to learn, you have to fail. You have to be willing to take risks and not always be right. And so to do great research or to do things that you have to take risk, you can't just do the things that are the safe things and be successful. So learning itself, and as the MIT tradition at that time, it was that you could do things and you expose them to very smart people in seminars, and that if you're wrong, they certainly told you about it. And I think that was a tremendous spirit that we had here in the 70s, that no one had pretensions that they were right, and we were just learning, and so we could be wrong. And by being wrong, you could learn, and by being wrong, you could grow and be right. So that's the wonderful part of the experience that we had here. And it was interesting, as Bob said, at the time, we just wanted to tell all we had learned to everyone. And we had set up in 1970, I think before you came, we had an educational program, and Gifford Fong reminded me that he was one of the first, he was a student in that program. So we had brought in people from Wall Street or who had not been in academics, and we told them, I gave a course with my research assistant who was helping me with the course was Michael Brennan. So it was one of our PhD students. So it was terrific in the sense that we could also, thought we were also sending messages and information, not only from what we said to ourselves and to the profession, but to the practitioners and those around us. It was pretty amazing. So I think that in my thinking about financial innovation and creating new things, in addition to what's happening in the world, is we don't really, that innovation really is built on trying to do things faster, trying to do things more idiosyncratically, and trying to do things more flexibly. And flexibly is, the optionality, and trying to understand how speed, flexibility, and idiosyncraticness affect all of us all the time, is how, is really sort of a dynamics of sort of the Coase theorem of how we organize things in our society and how we organize things generally. But on the other hand, those are the hunters, the ones who are innovating and creating. On the other hand, we also have the infrastructure people, the farmers and their ordnance and the like, and their general philosophy is to do things slowly, to do things not individualized, one shoe fits all model, and to be inflexible, And so we have this trade-off, as Simon said in his opening remarks, between innovation in finance or innovation in business or other activities where you have the startup companies in Silicon Valley or the Wall Street people who are trying to be the hunters and develop new things because they can do something faster for their clients or more individualized or more flexibly. And on the other hand, you have those who are the infrastructure people. So innovation by economic reasoning has to always lead infrastructure. You can't put a war general doesn't sit back and you don't put the ordnance guys up in the front lines and then you don't, and then all the war generals come in behind. That just doesn't work. So because of failure, the idea that not all innovation is going to be successful, and if some innovation is going to fail by definition of innovation, then you don't have sufficient infrastructure. So the major issues that we have in terms of corporations and thinking about it, how we have to evolve, I think, our thinking is this idea of flexibility. One of the most important things that a corporation has to do to add value is decide how flexible should their, as we talked about today, is how flexible not only should their financing policy be, but their operating policy. So, if we know that you can build, if you know something for certain, it's fascinating. If you know something for certain, then obviously the lowest cost solution is to do it in a hardware, to do it fixed, okay, without any flexibility whatsoever. And the more uncertain you are, then the more flexibly you'd want to build it, or the more the software route that you have. And then if you are in shock or times of chaos or whatever, maybe then your hardware and software is not working, and you have to redefine what your models are, how to think about the problem. So the interesting part of thinking in this way is to look what's happening with technology and look what's happening with communications technology, whether it's computing or otherwise, that what we're doing is we're becoming, in our society, have to think about how this flexibility or this desire for the ability under uncertainty to change the production processes of firms or change in finance is leading to more idiosyncratic solutions, smaller solutions. So what we're having is a complete destruction of the modern corporation, a complete destruction of the way in which we had operated and which we will operate going forward. The fascinating part of that is that it means that the volatility that we will see, okay, will never be constant because of how technology affects volatility and how it affects innovation. So you have now with the idea of myriad things like robotics, or you have 3D printing. I'll give you an example of robots in terms of flexibility. We used to have robots that did things, so you had a General Motors or other factories put a robot in the factory, and that robot was pretty smart. It had a big computer in it. But the problem was that every time you'd have to change what the robot was doing, you had to reprogram it. So you had to have a bunch of people come over and reprogram the robot, right? That takes time, not fast. And you have to reprogram the robot. So now, what we have with cloud computing, you have dumb robots, okay? And you put a cell phone in the robot's brain, and then you have software program that reprograms all the robots by sending it a signal. Why? Speed, faster to reprogram the robots because of the dynamics of the production process. 2, it's more flexible. You can make, it's not hardwired. And 3, it creates idiosyncraticness in the sense that you can do things in ways that are easy to do. And all of technology that you see is moving in this direction. So obviously, it has to change the whole nature of the underlying processes that we have and we're assuming. And so we have to learn to think about how technology and innovation are affecting these things. So from robotics to 3D printing to insourcing in this country to the idea of individuals as opposed to having it be that I produce something, I can produce more to what I want as opposed to what generally want is an evolution that's ever increasing and will continue to be so. So this is really the force of what is we're innovating. So the interesting point is that when Fisher and I initially developed the option pricing model, we did not, when we did it, it was for sort of the, we thought of there's two parts. I mean, one is the technology of the model, and the second part is actually what Bob had labeled the Black-Scholes model, which assumed constant parameters, constant interest rate, constant volatility, and for a period of time. Because what we had done, which was sort of assume that that for a short period of time, very short period of time, that you could have a model such as the capital asset pricing model or a factor model, and that when we did our replicating portfolio, we replicated, but at the same time, we didn't have it be the case that we could instantaneously that the process were necessarily constant. So our model initially allowed for there to be changes in interest rates and changes in volatility, and we can't, but then it would be obviously tough to integrate. So the interesting discussions we had today was how do we handle changes in volatility, and how do we handle changes in uncertainty, and how that's going to evolve over time. So I think that the, in terms of Bob's thinking, and then I sort of learned from thinking from the point of view of John and John Ingersoll's point, and he's very interested in what information do we get from skew and tail risk things. And in some work that I've been doing recently, there is information in tail risk. It does forecast downside and changes the distributions. In some sense, it's interesting because we look at our way of thinking of things in the mean variance world that, you take out the mean, but if you think about tail risk and concentrate on changes in volatilities in the tail, then basically the mean has an effect, because the further you're away from those tails, then the less chance there is of suffering as much loss. So it does come into play quite dramatically, and you can use that in ways to forecast things. I think that in Stu's case, when he introduced his subject, he talked about, these are things that triggered in my mind, is that he talked about finance as being market value, which is impressive and important. But yet, in our society as a whole, when we look at our success or whatever, we concentrate on GDP, gross domestic product. Now, if we were teaching our finance students to look at a corporation and say, just look at its dividend this period of time, under an assumption that the corporation has positive present value activities, but if we concentrate on GDP only, then basically if their value of the underlying investments are such that they're negative values, so that society's wealth is falling, then what good is it to increase GDP? So, it leads to a fascinating problem in terms of volatility and how volatility changes. Because if you ask me to dig ditches, the old thing, we can increase the GDP, or if we build bridges to nowhere, we can do so. So how do we get the idea from moving in the macro world from thinking about gross domestic product as being meaningful to getting us to think about wealth, either the value of our human capital or our physical capital, and trying to think about whether we're wealth enhancing or value enhancing. So we have to expand those views to those areas as well. And interesting enough, in society as a whole, what we tend to do is think about the possibilities of keeping GDP, gross domestic product. Like I've been in China and talking with the officials in China, and it's so obvious that what's happening there is this view that we have to preserve jobs, we have to preserve GDP, okay, and that we will give up innovation and creativity volatility, which is necessary to increase the wealth of our society, to preserve jobs by maintaining GDP. So we have in Europe, or potentially in the United States, but in China, the idea of thinking about, should we create no volatility for a while, hoping that everything will be fine, or do we create no volatility for a while and then you have a large shock? Because the Russian experience, you just can't maintain it. And so fundamentally, we measure volatility. Are we really measuring it in a correct way, which is a fascinating problem, because we don't see really what's happening. And it's interesting but for the interventions, what would be the volatility that we see? So, the standard illustration of letting the underbrush grow and putting out all small fires in Yellowstone National Park, and then after a period of time, you get lightning strikes in the park and you get a magnificent fire. And so in society, we have to think about volatility and how we think about smoothing versus shocks that are going to occur. We're going to always have shocks as a result. And if you look in terms of let's see, had something here about, I was thinking that, thinking about the drug thing in terms of what Judy had said, Judy Lewin had said, which is interesting to me. Interesting question is that here you had innovators or people who like volatility and uncertainty in Merck or other drug companies. They were the hunters. And then you had, at the same time, in corporations, you had a lot of the implementers or the farmers who could take the innovations and move them from innovation to going through all the regulations and marketing the product eventually. And then we've seen there's been a separation where the drug companies the larger pharma companies have become more innovators, and not innovators, more implementers or farming, and not having, and then having the research part or the option pieces being taken out of the businesses. And the interesting question is why that happens, and whether the corporations themselves change the volatility over time because of the nature of people who take over those corporations. Is it the case that farmers crowd out hunters? That's what we've seen in history, and Jared Diamond has written about that. And then I always wondered in reading his book, where do the hunters go? If they crowd them out, they got to go someplace. The hunters don't die, so they got to go someplace. And basically, they're the ones that are doing things generally. And so it changes the whole nature of uncertainty or volatility as these corporations and entities change their structure. It's not necessarily that society's volatility is reduced. It just, they go to Silicon Valley, or they go to pharma companies, they go into all the high-tech activities. So we could end up getting a separation problem. And one thing that was, Renee's case that was interesting to me was the idea of the difference between the cost benefits of equity and incentives. And one of the things that I thought that we had learned was to think about what risks does a corporation have to maintain and what risks can it transfer to others. And that evolution was sort of a great understanding in the sense that we think about to run a business, you have to concentrate. You can't diversify and completely make any money if you're completely diversified. So you have to concentrate to add value. But then when you're having a trade-off that we have between the cost of hedging or the cost of transferring risks like banks try to do through structured products and things like that, and what risks you have to retain. And if this changes over time, volatilities are going to change. And it's really a difference in cost between hedging or risk transfer in various forms and equity itself, or risk cushions of any form, or debt capacity. So those are all trade-offs that are huge research opportunities that we have to really think about, and whether with asymmetric information and the like, all these things are necessarily doable. And also, we have the idea that finance really, and economics is really not calendar time, it's volatility time. You know, it's the idea that one thing that I learned from the option pricing world is it's volatility times time. So if things are, it's Goldilocks and the Three Bears, you know, things are quiescent, quiet, nothing much happens, you know. So it needs more time. But if you have huge amounts of volatility, then time compresses. So basically time gets very short. So the interesting, so how do you hire people? How do you manage your firm? Do you manage your firm for quiet times? You know, you have two people and there's thousands of people coming in your store, or do you try to do it for normal volatility? And you don't have enough people to handle the very volatile times. So that basically, that's how it affects what corporations and individuals do. So the dynamics of your employment. So we might have less employment growth in terms of quiet times than when we have more normal times or volatile times. And so, you know, even how we hire people are actually very crucial. And Lucas's case, and it's terrific, is the idea of the fallacies of credit. You know, we learn nothing, I mean, from all these years in terms of credit, because at least from the macro point of view, that if you look at the crashes that occurred in the economies back in history, you know, it's always been the case that if you, as a creditor, if you lend someone more money, governments lend each other money in some form or other, that they'll have an opportunity to recover and come back. So that opportunity to recover and come back is an option. It's maybe way out of the money. No way it's going to be done. So, you know, that's lost. And the second fallacy of credit is that people are entitled to entitlements, and you can never reduce entitlements, even though they're not funded or valued, and as we were talked about earlier. And if they don't have these, they'll be unemployed, GDP will fall, and everything will be worse off. But unfortunately, you have to have, if you keep extending these, you have to, it's a way out of the money options that are not funded, and it's going to be very costly later on. And the third fallacy, which is in some sense funny, is we heard it in terms of Germany now lending money to Greece or Spain. The idea of exports. If you export to another country, you can increase your GDP and your economy by exporting. So you want your currency to be inexpensive. The problem is that if you keep extending credit to these other countries like Spain or Italy, et cetera, from Germany, and they never pay you back, then increasing your exports is good. But you know, there's no money to get paid back, so you have a way out of the money option again. So there's just very interesting things to do there. And in terms of skipping ahead a little bit, is the just quickly is the just talk a little bit about the CBOE, and then I'll end. So on that is that, yeah, I mean, one of the nice things that when you have an academic paper and then at the same time have it be very soon after its publication, or at the same time its publication, having an option markets being born, you know, it has tremendous interest, because you have an experiment going on right at the same time that you publish an academic paper which has a valuation to it. So it was, friends of mine told me that one is a PhD from MIT, and was gone to an investment bank for a job, and they asked him what he was doing research on, and he said he was doing research on black holes. And they said, "Oh, great, you're doing research on black holes, you're hired." He didn't even know what black holes was, you know. And then you had basically, in terms of Bill's rendition, you know, from my side and being involved in it, and Bob and I were watching this quite intently, because is that you have interesting phenomena in science or is one is that you had the grizzly traders who had huge amounts of experience in trading, well, trading over-the-counter options. And then you had the young Turks from MIT or other schools who didn't have any experience at all in trading anything, but they had the model. So you had the young Turks versus the grizzly traders. And we were watching it with the idea of sort of seeing, we had predicted that the young Turks would actually take out the grizzly traders who were trying to just use intuition, because intuition is a model as well. It has an error to it just as much as the Scholes Merton model has a error to it. So over time, it was the case that a very short period of time, I think shorter than what Bill had said, that the young traders tended to displace the older traders because their experience was limited. They didn't think of it as, they only had at-the-money options, and they didn't really think about the dynamics and hedging. And so I think that evolution was very fast. And the interesting part of the CBOE, which we were involved in at the time, was really the development of the first risk management systems using modeling, because it was the case that the floor traders who traded on the exchange had to be financed by banks or had to be financed by dealers. And so we had the O'Connor brothers, and, for example, who financed the traders. And so we developed models using the technology that would allow the traders to be neutral and make money by turning over their inventory or clipping coupons, and not by speculating on the prices of their inventory. They can do that at their own account because the bankers wanted to protect their downside. And so we built those models, and they worked beautifully, because you had short-dated options. They could be marked to market every day, and so we knew the positions in the books, and basically, it was the forerunners of later risk management systems that were built. But that time, it was interesting. Instead of what happened later at banks, and that risk management was integrated with making money. So it was an optimization problem. They're trying to optimize how much risk that their traders could take that they were financing through their bank loans. So it's a very fascinating process. There was a tremendous amount of learning that went on, and in that whole process. So basically, I'm excited now about things that I'm doing and the research that I'm doing, and I'm excited about, I still teach, but the only part I don't like about teaching is that students want hand-holding. They want a lot of reading to do and summaries of notes and that. I don't mind talking about ideas, things like that, or giving lectures and innovating and that, but that part I like to farm out, so I try to teach jointly with someone who enjoys that. So thank you for coming, and I enjoyed this day tremendously, and as usual, I learned something, and I learned things that will now allow me to continue to grow. So thank you, Bob, and thank you, every one of you.
So I guess I have a sense there's nobody running this part of the program. Suman, are you standing up to do that?
No, I was just going to say, we have a few minutes for questions. Well, actually, we have, depends whether the questions are for Bob or Myron, how much time we have. But, so I was just going to quickly ask people if they had any questions. There is the fireside chat coming up. John?
Oh, we have questions.
If you were developing the model today, would you patent it?
The interesting thing is that there's a conundrum you have, okay? And I've thought about this problem. If you say that you don't think something exists, okay, then you say you won't disclose it. But once you find something, then you worry like mad, that someone else is going to discover it first, or, and so basically, I think you're forced then to publish it. But I would have liked, for the 16 million a day contracts that are traded on the CBOE, I would like a mill, which is about 16,000 a day, that per contract traded, and I'd even split it with Bob, Fisher's estate in some sense, and that would be fine too. I mean, it goes back to the idea of Bob mentioned earlier with the TI calculator, but in a lot of ways, rewards such as this is incalculable. So I don't exactly know how to price that, but I think that basically, obviously. Have no regrets. And at the time, we couldn't really patent
No, you
it.
couldn't patent at the time, but I think it's also fair to say, and Myron, you can corroborate about Fisher, because sadly he isn't here. Fisher, at least to me, and I can imagine he said something different to you, said he actually thought just pure economic terms. Now, obviously, if you had the right patents and all, but in pure economic terms, he thought we probably did better doing what we did. Because what you have to think about is if you create something that's proprietary of that sort, either people will find a way around it, which means so what, or they just may not use it. It doesn't become a standard. So it's very tricky to figure out what you get from it. Plus, the two of us were academics, and it never occurred to us not to publish it. I mean, that never was never on the agenda. So it's a good question. I agree with Myron. When you see the volume, we could, if nothing else, we could probably endow the new center. Fortunately, we have very generous alums who believe in what we're doing. But anyway,
Yes.
I just found myself wondering, is there any outstanding, unanticipated consequence of this formula that you think about?
Unanticipated in good or unanticipated in bad?
Okay, go away.
Well, no, actually, for me, it was the exponential growth of the use of this technology, the evolution of technology that has occurred subsequent to that. Now, obviously, when you look back at something, it looks linear, even though it's exponential, and then you get sort of this explosive effect. So over time, how it has become, A, standard, and B, sort of used as, and survived to this extent, still used and trying to be understood and grow upon, and more research on, as Steve Ross's paper was indicating, and Doug Breeden's paper. That's really exciting to me. But that, the longevity and the exponential growth. Pardon me?
You didn't think that would happen?
I didn't anticipate it. When we initially did the work, I was thinking of as valuing options and corporate liabilities. I didn't think at the time that once you have the technology, it'll create an evolution of a whole new ways in which you can create securities, because you have now technology and not just intuition. So we're going to see in the future, which I think is really crucial, is we have too much, debt contracts are just too static right now. Things are too static. As the technology develops and as the computing and other technology develops, we're going to have much greater dynamics built into how to reduce the deadweight costs. So I mean, I think that we're still going to have a lot of exponential growth, and not only from the options models itself, but from having people with technical skills and knowledge who are attracted to the profession because of that technology, and now the myriad other technologies that have come about as a result.
Yeah, I wasn't quite sure the nature of your question. It could be, did you anticipate all of what was going to happen? And I agree with Myron, we had no idea of this magnitude and speed. But we did understand early, and the students, some of them who were here know it too, and Stu for sure, I mean, he created all of real options. When it happened, and once you saw it, and you saw the corporate liabilities, it was pretty quick that you could see the enormous number of potential applications. Now, I wanted to go to Venice. I'd never been in Italy. I got an invitation to go to a banking conference, and I had to give something on banking, and it was going to be published in this first article. So I said, what can I come up on in banking? I said, oh, how about deposit insurance and loan guarantees? I can write that one. That's just puts. I made some tables. I did that. I got my trip to Venice. You know, and it turned out to be a very widely cited paper. So, and I think that happened to all of us. That's not unique to me. I mean, that was the spirit of what was going on. So that part's there. Another interpretation of your question is, are there unintended consequences of the, I have to put a footnote in that was already said. The formula is a special case of the methodology. And it's the methodology that really has preserved itself all this time and is still used. I mean, you heard today about all the improvements. And a lot of the criticisms of the model is all about the special assumptions for the formula, which are only used in rather specialized cases. But I thought that possibly what you're asking, were there unintended consequences, and is, you know, there's nothing in this world that's completely functional. Everything has a dysfunctional aspect. So you heard some of the mismatches on innovation. There's no question innovation creates greater risk potential. That's not just true in finance, that's true in everything. So we have to trade that off, and it can be that sort of thing. But I think the spirit, and that's why I was talking about some of the popular stuff you hear that would suggest that nothing had been done in finance except, you know, doing it. It's an easy decision if you believe that, because then you just shut it down. And that's just far, far from the truth.
Also, yeah, I mean, also from the, sort of following just a second, is that you have a survivorship principle. I mean, if you see 16 million contracts a day are traded, you know, it has to have value for people, because if it's just a game, you know, it disappears. And so you see the over-the-counter markets, and you see the evolution of use of these contracts. You know, people are valuing it.
Okay, well, I think I'm the real boss. Kelly Nixon here, who organized this whole thing, is telling me that that's the last question we have time for. Thank you.